Welcome to TheoTrade. This is Don Kaufman. It's October 19th, 2018, and you are watching the TheoTrade Weekend Update. Little change up this week. I happen to be recording this video here on a Friday afternoon. The markets have closed just moments ago. People, another kind of rockin' week in the marketplace. But the big, and I guess the $10 million question that I've been getting all week long, whether it's email, whether it's in our chat room, whether it's literally face to face, people are asking me like, is it over? And is the volatility, is it over? All right, are we through some of the volatility? Well, right here, right now, I'm going to give you a couple of very clear, very definitive reasons to stay hidden under your desk for the time being, because we ain't out of the woods just yet. We're expecting some fairly substantial volatility, especially in the near term. Let me get to some of the specifics because, just throwing that out there, it's an opinion, right? If somebody says, hey, what do you think about volatility? And well, I don't think it's over. And that's exactly my opinion. I don't think this volatility is over by a long shot. But let me give you, again, definitive reasoning to why I am taking that stance. Number one, SPX. Now, you may know it, you may love it, you may fear it, and you should fear it. But the SPX has an expected move. Now, on the weekly expected move, which we've been tracking for, umpteen weeks, actually about 2 years now on the chart, and we share those where we actually hand draw the expected move. That's the options market kind of depiction of risk. First of all, the expected move this past week, that's the week that we just went through, was right around $71. Now, a $71 expected move, you're like, oh, okay, what does that mean? Well, you got to think about the prior week, when the S&Ps, they had like a 100-point day. So this past week with a $71 expected move, that is a big move. Can't stress that enough. It's a really big move that was being anticipated. But the interesting part of the expected move of this past week, and the reason I'm kind of highlighting it right now and taking some time on it, we didn't get anywhere near the edge of the expected move. That is, we were, again, positioned to move $71 higher, $71 lower. We moved higher. We moved lower. We moved way higher on Tuesday during the rip and rally. I mean, we moved 70 handles in one trading session. Okay? But the concern for this coming week, now again, it's October 19th. We're moving forward. Let's not be too backward looking. This next week, did you know that there's right around a $66 expected move in the SPX? If you think volatility is subsiding, why is there a $66 expected move inside of the SPX? Now think about that for a second, because we got, again, nowhere near the edge of the expected move last week. But again, this next week, the marketplace is telling you something. And you know what? Listen to the marketplace. Don't listen to me. Listen to the marketplace. There are billions of dollars at risk in the SPX, and it's telling you it's going to move. Number two reason over here, VVIX. That's the volatility, or what they call the VVIX. It's the volatility of the volatility index. Now, some of you may or may not be aware of the volatility of the volatility index, and you're like, what is the volatility of the volatility index? It's the risk, inside of the VIX itself. When the VVIX is at 115, what it's effectively saying is trading firms are like hedge, duck and cover, hedge, duck and cover. Trading firms are buying themselves, out of the money call options in the VIX just in case. Now that unto itself doesn't indicate much of anything, right? But that alongside of you have an elevated, of course, expected move, now you're starting to get a little worried. Okay, number three over here, the XLF, the financials. The financials, if you look at a specific level, and I've talked about this extensively on some of those kind of daily or evening updates, the XLF, the 2650 level. I'm going to show it to you here in a minute when we get to the charts. 2650, you're like, well, what is 2650? It's the make or break. It was actually kind of the low that we hit back in February. We threatened it again a couple of times this summer. 2650, it is like the bane of my existence right now. All right, the XLF is just hovering above 2650. XLF under 2650, and we are gonna be in the throes of some really serious volatility. All right, that was number three. Number four, the Russell. Just take a look at the Russell. Enough said, we're gonna show it in a chart over here. The Russell, the small caps, they're getting eaten alive day in and day out. And the Russell, even though it bounced on Tuesday with the rest of the market, and it had a wicked bounce. And by the way, we caught almost every ounce of the bounce to the upside. How about that? I took a bullish intraday trade, huh? Crazier things have happened. Nevertheless, the Russell is getting hammered as this week kind of wore on. And I think the small caps, you have to pay a lot of attention to them right now. Why? Because they were actually on the sell side well before the S&Ps. And last but definitely not least, for prolonged volatility, look at anything right now involving housing. Have you looked at any housing stocks, or better yet, the XHB, which is the ETF related to the housing? I mean, we can go through housing stock after housing stock. All right, it's hideous. You know, like Toll Brothers down like 37%. We can look at Pulte. We can just go on. DR Horton, they're getting annihilated. Okay, that's real economic consequences, longer duration. Many of you know that I'm actually in a position specifically in Lowe's. Tried to get filled at Home Depot. We got filled in Lowe's. I'd keep an eye on those Lowe's positions because that's an underlying, that's a short position in Lowe's. Been working out very effectively. All right. Also, we're going to take a look a moment here at Visa and MasterCard, which is indicative of credit health of the consumer. Again, these are all factors that we need to kind of consider for what we're looking at right now is some really prolonged volatility. And with that, what I'm going to talk about here also in a moment is kind of feel like we're in a bit of a transition in this marketplace. And the transition is, you know, for a long time, low volatility. I have actually been buying premium. That's buying option premium because it's been really effective to be on the buy side of options. But the transition is this slow allocation over to the sell side. Things like iron condors kind of becoming like in vogue. We may even see the reemergence of calendar spreads and diagonals, back ratios. Ooh, oh my, I'm getting excited about the project over here. I grew up around premium selling. The last 4 or 5 years have been painful. You know, staring at your screen in a 12 VIX doesn't exactly like excite you in the morning. Now we're back up, you know, 20 some odd VIX. Okay, we are getting rocking again. But I'm telling you right now, this marketplace still looks like it's going to throw off some serious volatility, possibly some shock and awe. Let's get to it. Let's take a look at a few of the charts. To the charts we go, and let us start specifically inside of none other than the mother of all products, the SPX. Now, the point that I was making just moments ago, kind of on the video portion of this, was the expected move being quite considerable, of course, this past week of trade. And the point I was making was, well, specifically, this was a $71 move, either higher or lower. Again, $71 move. That is a very large move. And we didn't really get anywhere near the edge of the expected move to the higher or to the lower end of that expected move. And I guess the interesting irony on this entire past week, because we had some decent volatility this last week, is this is exactly where we started the week. And ironically, this is exactly where we ended the week. So we went everywhere to get absolutely nowhere this week. And again, on a $71 expected move, why did we have such a large expected move? I don't know. Maybe it could have been, you know, what? Wednesday, Thursday, Friday of last week, blowing through the edge of the expected move, almost 3 sigma kind of move. But what I fear now moving forward is, quite simply put, this next week. And this one, again, you can see giant highlight over there. And the reason I'm doing the giant highlight is to draw your attention simply to the fact of, again, for the life of me, I look at this and it's a $66 move, either higher or lower. And usually what you get is after a week where the volatility expands drastically, you get a big contraction because we didn't even get close to, again, touching the edge of the expected move. And yet we're still sitting on a $66 expected move. So, you know, put all geopolitics, everything aside, forget announcements over here. The market wouldn't price that kind of risk in. The market is pricing in, again, a huge amount of risk. And I guess the irony is you can see it, again, almost perfectly represented here. The volatility just came in an absolute hair from the previous week. And that, again, it doesn't bode well for those of you, like if you're looking like things to kind of quiet down a little bit. At a glance here, let's also cruise over to, as I said, the VVIX. The VVIX still rocking out there at around the 115 level. As I said, again, that doesn't necessarily mean anything unto itself other than the VVIX. What it really measures, okay, what it really measures is the option volatility, specifically in the VIX. And if you want to put that into context, I'm going to tell you exactly what it means. The VIX right now is trading what? About 20. On the button, almost 20. And in the next 32 days, they're looking at over a $5.50 expected move. Oh, you're like, okay, so that's a normal move. That's a probability of expiring. Okay, kind of take that and double it. So you're looking at a $10 or $11 move on a $20 instrument. And that's some of the possibility of what we term probability of touching in the next 32 days. Okay, that is a little bit of alarming. It's a large number. Now, the third point that I brought up a little bit earlier in the video portion had everything to do with the XLF. And the XLF, and this one I'm going to expound upon as well. If you even pull up like a 3-year, you'll see how very important 2650 happens to be. And I think a crack under the 2650 level would really be indicative of the entire market at that point in time, throwing in kind of the proverbial towel on large caps. And that's one thing I haven't really talked about just yet, and I'll get to a little bit kind of later in this video portion though, is that large cap underlyings, although you kind of deem them having been under pressure, they're still relatively unscathed. I mean, Apple's stone's throw off of its all-time high, which we'll look at here in a moment. But when it comes to large caps, got to talk about the financials. And as I was showing you, here's some of the February trade. We came close again in early April. We got tortured in late April. Okay, this summer it was like, whoa, this thing is getting crazy. I mean, it was the financials pulling back the marketplace over the summer, and here we are once again. It is kind of a dire area. By the way, once, twice, third time, fourth time. What is it? The fifth or eighth time, if you will, right now is the charm. And again, strictly my belief. Elevated volume. Okay, there's elevated volume now that is displaying in there. And if you take a look under option statistics, though, the implied volatility isn't exactly rocking in here, which it very much kind of leaves us in a lurch. But I'm going to give you one other area of interest to me. The amount of activity in the XLF today, all right, we traded almost 3.5 times the number of puts. Now, again, that unto itself wouldn't really make much of a difference to me, but why are there all these puts being traded in here? First of all, it's kind of a low IV ranking, so this could be a monstrosity put purchase. And for those of you so inclined, you can even take the time going to time and sales, and you'll actually see specifically some of the trades. It was actually a part of a spread that was done in here, but people, there are trades happening inside of the XLF in a big way. This is actually algorithms kind of going off. Hundreds of thousands of contracts trading specifically a little earlier in today's session. Again, right around this key inflection point, and I'm very suspect of some of the activity that is kind of persisting inside of the financials. And again, strictly opinion, I think we're actually going to blow right below the 2650 level. And that would be a sign of, again, much more dire volatility inside of the broader marketplace. If you're not buying into that one, well, cruise over here to the Russell. I'm actually pulling up the IWM, and I just want to show you this on a year-to-date percentage, because this one actually screams to you a little bit more in a year-to-date. So on a year-to-date basis, this little monkey was up about 13%. Its fall from grace has now taken it down on the year. Wanted to point that out because very few people are looking at that. And the other thing is the Russell product itself this particular week. Let me kind of highlight into this trade. All right. The bounce was just met by sell side activity, which for the most part, it's a rip your face off rally being met by sellers. This looks like there's going to be some follow through. Again, the Russell almost aligning very similarly, if you will, to the financials. And clearly there's a high correlation between the Russell and the financials. The Russell happens to be filled with small cap and mid level kind of banks in it. All right, so enough of the Russell. Speaking, by the way, of the Russell, let's go one more step into here. If you look at the option statistics, it's actually got a little bit of a higher IV rank. And again, I'll talk about this in a moment. This is where I believe we're right in that transition of starting to want to sell some premium because the IV ranks, they're starting to pick up over there. All right, the next thing I brought up was, of course, some of the housing stocks. So if you take a look at the housing stocks, this is the home builder ETF. I'm going to start here. I'm not going to finish here, but I'm going to start here. The home builder ETF. It's getting absolutely decimated. There's nothing else to say about the home builders other than, what, they're down 25%. Now, hey, listen, oversold. In fact, if you're into technicals, here's the TheoTrade RSI Laguerre. You zoom into this, look at that. That thing is a flat line. If dead means anything to you, well, the XHB is there. The thing is, again, an oversold territory. Maybe it does have a bounce back up. However, let's just put this in broader context. As I said a moment ago, this has real world implications. These are companies that are going to have to start to cut back. Their stocks are getting annihilated. They're the home builders. And that's where everybody's like, forget the retail world. There's Apple. And Apple, of course, is supported by the retail world. There's Google, which is supported by advertising. There's Facebook, which is nothing but advertising. And go on and on. Again, what we have, all right, is a marketplace where some of the smaller caps are starting to get hit, like in the Russell. The housing market is taking it on the chin, and nobody seems to be paying attention. Right? If you look at XHB, fine. Don't believe me on XHB. Look at some of the individual stocks. Let's go over here. This is Pulte. Pulte's actually down 35%. Okay. Close that up. Let's go over here to Toll. Toll is getting absolutely hammered by the tune of almost 38% on a year-to-date basis. By the way, that was actually a gap up because their numbers were really good. It did not matter. The number was good right until they beat that thing into the ground. Oh, and even more fun, pull this up at a much longer duration chart if you want to see some wild moves. But it was like they forgot about this sector until they remembered it and decided to sell it. Nevertheless, Toll Brothers, it's like this thing almost looks like Tesla in terms of its volatility. Last but definitely not least on the docket for this would have to be its DHI, it's DR Horton. DR Horton, interestingly enough, this one, come on, it's the outperformer over here. It's only down 30%. Now think about this. Again, real world implications for these underlyings. They're getting hit enough such that the dividends, okay, you got to worry about companies that are getting hit this much. That is beyond bear market territory of the home builders. Now, along with some of the housing stocks, of course, I've been looking at things like Lowe's, okay? Lowe's, which was up just shy of 30% on a year-to-date basis, is now up, 8.7%. Granted, we've been short since right around here, right where that, X marks the spot. We got short and we've actually ridden this thing down considerably. If you want like a price put to that, it's about the 113 level we shorted it. It's now dropped about $13. So we are in the money on the Lowe's trade. But okay, corresponding to it would, of course, be Home Depot. And Home Depot, on a percentage basis, again, it's getting wild out there, people. Things are getting nutty. And this is where everybody seems to be turning a blind eye. Why? Because the S&Ps, they're rather unscathed at this point. They are. They're rather unscathed. And I'll come back to this again in just a moment. The other stocks I want to bring to your attention, when you talk about the consumer, you have to start to worry when Visa and MasterCard are getting hit, because this has to do with consumer credit worthiness. These are underlyings that were up 32%. They've dropped. However, okay, these could have some room to run. The earnings are coming out. I think you have to kind of let some of the earnings come out prior to trying to jump into this. It's a little bit late to the party. Nevertheless, if they're bid up on the earnings, that's when I'm actually going to be on the short side of it. I'm also going to bring up MasterCard to point out, still up 33% in a rising interest rate environment. Say what you will about interest rates. Okay, even if interest rates don't rise, I'm going to show you one other aspect on that front. So the last thing I want to point out over here is exactly what I was saying a moment ago. Inside of the spiders, which were up, to the tune of almost 10% year to date, have fallen back. They're basically, up about 2-3% on the year, which is, no surprise, obviously, given some of the volatility we've seen. All of that damage effectively done in the last 2 weeks. Remember, we're expecting more volatility moving forward. Now, the reasoning for the S&Ps only being, 2%, okay, is your large caps haven't participated. The large caps haven't gotten hit yet. So again, everybody's focal point on a day-to-day basis, got to tune into tech. Tech's getting killed. Really? Because Microsoft's just a stone's throw off the all-time high. Let me just pull up price chart. It's $8 off the all-time high. It's $8 off the all-time high as Microsoft. And wait for it, it has earnings coming out with a $6 expected move. So I don't want to hear this stuff, okay? There hasn't been any sell-side activity, except it is a bear market by select sectors, okay? It is a bear market by select sectors. The question is, when do they throw in the proverbial towel on some of the large cap? If you want to bring up Apple, Apple also, proofs in the pudding over here. The high of 233, we're $13 off of it, okay? And with earnings coming out, oh, here's the interesting irony. The expected move is $13. Right now it is. It's gonna shallow out a little bit, but in the next 2 weeks, it's a $13 expected move. Stones throw off of it. Again, look out to the S&Ps. When I say look out, I mean, hey, look out below. These things have the propensity for a massive sell-off when you already have so many, okay, of these smaller cap, and they're still pretty good sized companies. So many of these companies, though, in so many sectors that are incredibly beaten down. And then we have what? A handful of these generals that are just holding us together, okay? Another front that I want to talk about happens to, of course, be interest rates. And I've talked a lot about bonds, but I just want to bring this up briefly. This happens to be none other than the Federal Reserve balance sheet. If you're not into interest rates, okay, let's say the interest rates do not go up anymore. We're still in trouble. This is actually the balance sheet. And if you look at the date down below, okay, this is from 2008 and pretty much until this current week. And as you start to look at the balance sheet, that's the decline of the balance sheet. But as you zoom in on it, it's a very, very different chart. Here's year to date. All right, this thing is absolutely crashing and burning. It's going to accelerate. There's 1 year. And of course, this is the last 6 months. Federal Reserve balance sheet people, okay, they're whacking the balance sheet. There's no question about it. This, to me, matters much, much more than does the interest rate starting to go up. I mean, that, by the way, the 4M, it's over $4.5 trillion. And now they're actually, of course, contracting it. That is effectively the punch bowl. Last thoughts. Again, we've gone over the levels inside of the S&Ps. We're looking for 2731. We're even looking for 2682. But again, we're a marketplace in transition. I will be selling some premium, but with a very, very, short amount of allocation, meaning that I'm just not going to overextend my allocation. It doesn't look right. Day-to-day basis, things have just been too kind of neat and clean, even during bouts of fairly extreme volatility. We got to see this marketplace before I'm ready to really step in and start to rock and start to sell some premium. Got to see this marketplace just get ugly. All right. And yeah, the other day for what, a glimmer, we did see the marketplace trade all the way down to 27, 12. For again, a few moments we saw some ugliness. People, we got to get ugly before we're going to get really inefficient and really start to open up some great opportunities. Have a wonderful weekend, everybody. Bye-bye.